You know that little piece of plastic in your wallet? It feels pretty simple, right? Just a convenient way to pay for stuff. But behind it, there's this massive trillion-dollar system with a fascinating and, for a lot of people, a really dangerous history. So today we're going to break down how credit cards became so central to our lives and how they were designed with a trap that's incredibly easy to fall into, but very, very hard to escape.
Let's just start with the sheer scale of this whole thing. Right now, Americans are carrying over $1 trillion in credit card debt. I mean, think about that number. That's a 1 with 12 zeros after it. It's a mind-boggling amount of money held by millions of ordinary families. This isn't just some abstract number. It's a national crisis.
And here's what makes that debt so absolutely crushing. The average annual percentage rate, or APR, on a credit card is now over 19%. That's a historic high. Just a decade ago, it was hovering around 10%. So this isn't just debt, it's incredibly expensive debt that grows frighteningly fast.
So you gotta ask, right? How did we get here? How do we get to a point where so many of us are paying such ridiculously high rates on so much debt? Well, to understand the trap, you first have to understand how it was built.
You know the whole buy now, pay later thing? It isn't exactly new. But the modern system that traps so many people, that's actually a surprisingly recent invention. It was born from a forgotten wallet and then completely transformed by a single court case.
So the story starts back in 1950 with the first charge card, Diners Club. But here's the catch. You had to pay it all off in full every single month. The real game changer came in 1958 with the Bank AmeriCard. You probably know it better as Visa. It was the first card to introduce the most crucial feature of all, letting you carry a balance from one month to the next. And that is where interest enters the picture.
Now, for a while, there were actually rules that kept those interest rates in check. But then came 1978. A single Supreme Court decision completely blew the doors off the industry and really paved the way for those 19% rates we see today.
Okay, so the key concept here is something called usury laws. Sounds kind of old-fashioned, right? But for decades, these state-level laws were a huge consumer protection. They basically set a legal cap on how much interest a lender could charge you. So if you lived in a state with a 10% cap, that was the most you could be charged, period.
The system flipped completely on its head in 1978. A Supreme Court ruling declared that interest rates weren't based on where you, the customer, lived, but on where the bank was based. And that one little switch changed absolutely everything.
The result? It was a gold rush. Banks basically packed their bags and flocked to set up their credit card operations in states like South Dakota and Delaware, states that were eager for the jobs and tax money and had gotten rid of their usury laws. This meant a bank in Delaware could now legally charge a customer in California any interest rate it wanted. And just like that, the modern, high-interest credit card industry was born.
So this legal loophole created the perfect environment for what has become the industry's most profitable and honestly, most dangerous feature, the minimum payment trap. It's the mechanism that keeps millions of people stuck in debt for years, sometimes even decades.
A perfect way to picture this is to think about walking up a down escalator. When you pay only the minimum on your credit card, it feels like you're making progress. You're moving your legs, you're putting in the effort, but in reality, the escalator is moving down against you at almost the same speed. You're working hard, but barely getting anywhere.
So here's exactly how that cycle works. You make your minimum payment. Great, you just took a small step up. But then, bam, that high monthly interest charge hits. That's the escalator pulling you right back down. Because almost your entire payment gets eaten up by interest, your actual debt, it barely shrinks at all. You're stuck in this loop that's designed to profit the bank.
And make no mistake about it, this is by design. Look, the credit card industry isn't a charity. About half of all cardholders are what the industry calls transactors. They pay their balance in full every month. The other half, the ones who carry a balance and get caught on that down escalator, that's where the real profits are made.
And is it a profitable business model? Oh yeah. In 2022 alone, major banks collected over $105 billion in interest payments. That's the money being generated by keeping people stuck on that escalator. Okay, so the system can feel pretty rigged. It can feel pretty bleak. But you are not powerless. Now that we understand how the trap works, let's talk about how to get out of it. Financial experts have some very clear, actionable advice on how you can get off that escalator for good.
All right, financial experts pretty much all agree on a few key steps. First, attack your highest rate card. The math is simple. The higher the APR, the more expensive the debt. So pay that one down as aggressively as you can while just making the minimums everywhere else. Second,
look into a 0% balance transfer. This lets you move your debt to a new card and gives you an interest-free window to pay down the actual principal. Just be really careful you pay it off before that promotional rate expires. And finally, and this is a big one, ignore the gimmicks. Points, miles, cashback, they are all designed to make you spend more. Your only mission is to get that balance to zero.
And of course, it's so important to acknowledge that for many, this isn't about luxury spending. Millions of Americans are using credit cards just to stay afloat. They're covering essentials, a sudden car repair, an unexpected medical bill, or even just groceries and gas when their wages don't quite stretch to the end of the month. And that really gets to a much larger point, doesn't it? The credit card crisis is often a symptom of these wider economic pressures that are facing American families. You've got stagnant wages, the high cost of healthcare, inflation on everyday goods. It all creates a situation where credit feels like the only option left.
So this brings us to a final, crucial question you have to ask yourself. When it's used carefully, paid off every month, a credit card is a really convenient tool. But with those high interest rates and the constant lure of the minimum payment, it is also one of the most effective traps in modern finance. The key is understanding which one it is for you.